Alright, so following the latest video that was about market structure and breaks of structure and changes of character, in this one we need to talk about supply, demand and order flow. Market structure is important, but much more important is the fact that supply and demand basically rules the market, and also order flow. We always need to know which kind of order flow we have going, if we have a bullish order flow or a bearish order flow. So what that means for us is we can anticipate where price is going, and we also need to know that in order to take a trade in a certain direction. So let's say for example we want to take a buy, we need to have the order flow aligned bullish for us. So order flow needs to be in our favor all the time, depending on the time frame we're trading in. Best trading scenario is when all the time frames are with the direction you want to trade. So if you want to take buys, best is that you have 4 hour all the way down to 1 minute bullish in order to take buys. We are gonna use changes of character in order to identify when we realign in a certain direction. So order flow basically means once we have bullish movement, once we have that bullish market structure, means we are in a bullish order flow, and when we are bearish, that means we are in a bearish order. So here we have bullish order flow, and that will change once we have our change of character. So once we have something like this, then we are switching to bearish order flow and we can start looking for sells. Any trade we take, especially if we are entering on the 1 minute, we will use order flow alignment in order to enter the trade. Now, next thing we need to know is supply and demand. Again, if you have experience trading, then you probably know what that is. Basically, when supply is in control, price is going bearish. When demand is in control, price is going bullish. So same thing as order flow. But we need to also know how to identify supply and demand zones. Now, we're not gonna only use supply and demand, we're also gonna use imbalances. It depends on the setup, but because you are part of the mentorship, you will have my daily outlook, so you will know what targets I'm looking for and what entry points I'm looking for. Supply and demand is usually marked by a candle. So let's start from the 4 hour. Usually 4 hour supply and demand, we mark it when there's basically an opposite candle of the direction we're going in. So, and also before a break of structure. So here you have breaks of structure. So you have a break of structure to the upside and another break of structure to the upside here. Once you create a break of structure, you also create a valid demand zone because price is going bullish. So in this case, it's going to be the last bearish candle before the push that caused the break of structure. And that's going to be demand zone that we're going to mark. Same thing when price is trending down. All right. And we have breaks of structure. Every time there's a break of structure, the last bullish candle before that caused the move to break the structure is going to be our supply zone. And most of the times when price starts to have the pullback, it will come back into our demand or supply zone. So it's going to come back there. It's going to create another zone. Now we have supply and demand zones. We're also going to have flip zone that we're going to talk about. But most important is to understand supply and demand. So now let's go and mark some structure and supply and demand on our 4 hour chart on EURUSD. So I am looking for candles opposite to the trend we're going. So here you see we had a break of structure here. So this was a break of structure. We need to identify which candle was the last bearish candle, was the first actually bearish candle that caused the move. So this is the move up, and we have one candle, which is this right here that we mark. Now there's multiple ways of marking supply and demand. The way I like to do it is I like to mark the bigger area and then refine the area to the extreme. So anytime we have a supply and demand zone, we're gonna have the zone in itself and we're gonna have an extreme zone. The extreme means the last point where price can come. So in this case, I'm gonna mark also this week here, gonna be marked like this, and then I'm gonna mark another zone which is only gonna be this week right here. Why the week? Because if we go down on the time frames, on the 1 hour, you're gonna see that the wick is actually the first 1 hour bearish candle that started the push up and also caused the 1 hour break of structure here. So that's why it's important to mark the extreme zone. You can go down on the time frames, you can go all the way down to the 5 minute mark and 15 minute, 5 minute. It's best to go down when we want to really refine the zone where price can tap in. Here, if we go down on the 1 minute, you can see we had a huge imbalance, and also you can refine it even further to this. But because we also had an imbalance, I'm gonna mark it like this. Balances will be talked about in the next few videos, but this is important to know how to mark. And then you can see price probably return to that area, tapped it, and then have a nice reaction. So most traders, they mark zones and they just immediately start trading from those. That is not really correct because you don't know where it's going to react from. You can't predict the market. Everyone who says you can predict the market, you can have sniper entries is wrong. All we know, price is like these zones are like a magnet for price. Price is going towards them. In order to mitigate them and then have a nice reaction. So in this case, price tapped into the zone and then give a bullish reaction. It could have gone to the extreme and give the reaction, but it just tapped the zone and then rejected price. So that is why we mark the whole zone, and inside here, when price is tapping into the zone, we're gonna look for trades based on our criteria, which are gonna go into our trading plan. Let's go mark another, was a demand zone, let's mark also a supply zone. So a valid supply zone, one that looks really good, we can mark it like this. The last candle before we pushed down and had this break here, which was on the 1 hour. We have another one here, you can see another one here where price came. So the last bullish candle before this huge drop, price returned to it, tapped it, extreme zone, the wicks there. You also need to have the extreme is always best mark when you don't have a mitigation towards it. So for me, if let's say we have this zone, once price tapped into it, it's no longer valid for me. Instead, what I can do is look for the unmitigated portion. So that would mean the extreme. So if price gives a reaction but comes back here, I'm not gonna enter another sell. Instead, I'm gonna wait for price to come to the area that was unmitigated and try to get a sell there. That way we can avoid a lot of losses. Let's look for more areas. Here you have a good example. In this case, because there are tons of wicks, you don't really know which one to mark, so you can always mark a bigger zone. We can mark it like this, because if we go down, if you go up on the 12 hour or let's say the daily no, 4 hour, 2 hour, 1 hour, right, you're gonna have two zones. You're gonna have this one here, and here you see you don't really have much, so you can either mark the whole. The way I do it is, yeah, basically just mark the whole area here and see what price does when it taps it, and then look for entries here. The deeper price goes into the zone, the better risk you're gonna have if you look for trades. So here you see it tapped in, then gave a nice reaction, created equal highs here for liquidity. Price came back down to the extreme to mitigate, and then price moved up. So you see how perfect this was. Again, these are also called, you can also call them order blocks or institutional candles, the last candles that cause the push. I just like marking them as supply and demand because it's just simpler. So we're gonna call it that. Also, we're just gonna call them zones. So I don't want to overcomplicate things. We're gonna look for zones where we want to trade from and where we want to trade into. So these zones can be supply demand, these zones can be imbalances, these zones can be points of interest or institutional candles. We're also going to talk about that. But for supply and demand zones, you can mark them on the higher time frame. I usually like to mark them from 4 hour all the way down to the 1 hour and even 50 minutes. That's because they look more clean. And then from there, when price taps in, we're going to look for refinement. We're going to look for an institutional candle or a point of interest. Then we're going to wait for confirmation and our time to trade, because we're going to only trade 2 setups a day, and in the certain time frame, it's not going to be hard to take trades. You're going to see it's way easier than it seems. But supply and demand is a concept that we need to use. So just wanted to give a quick rundown, and once you understand every concept, we're going to go ahead and apply all of them, and then we're going to practice towards it, and you're going to understand better how to market and how to trade from it.